Most Americans don't have a money problem. They have a timing problem. They build credit just years too late. By the time they qualify for better rates, approvals, and opportunities, they've already overpaid thousands in interest and missed doors that never reopen. And no one ever explains this part clearly. In this video, we're breaking down the 7 credit milestones most Americans hit at least 5 years too late, and how that delay quietly holds people back financially. Before we get started, if you want to understand money systems before they work against you, hit subscribe. This is where financial blind spots get exposed. Number 7. Getting your first credit card. Most people wait until their mid to late 20s to get their first credit card. But this is a massive mistake. The ideal time to start building credit is at 18, right when you become an adult. Here's why this matters so much. Your credit history length makes up 15% of your credit score, and the clock doesn't start ticking until you actually have credit in your name. Every year you wait is a year of credit history you're losing forever. Think about it like this. If you did your first card at 18 versus 25, that's 7 extra years of credit history by the time you're 30. That alone could be the difference between a good credit score and an excellent one. The solution is simple. Get a student credit card or a secured credit card as soon as you turn 18. Use it for small purchases like gas or groceries, and pay it off in full every single month. You're not trying to go into debt here. You're just trying to establish that you exist in the credit world and that you're responsible with borrowed money. Number 6. Reaching a 700 credit score. A 700 credit score is where doors really start to open, but most Americans don't hit this milestone until their early 30s. You should be aiming to reach 700 by your mid-20s at the latest. Why does this specific number matter? Because 700 is the threshold where you start qualifying for good interest rates on car loans, better credit card offers, and you'll have an easier time renting apartments. Below 700, you're often stuck with subprime rates or getting denied altogether. Getting to 700 isn't rocket science, but it requires consistency. Pay every single bill on time, keep your credit card balances below 30% of your limit, and avoid opening too many new accounts at once. If you start building credit at 18 and follow these basic rules, hitting 700 by 25 is totally achievable. The people who wait until 30, they've already paid thousands extra in interest rates on car loans and apartments during those 5 years. Number 5. Having multiple types of credit. Your credit mix accounts for 10% of your credit score, and most people don't diversify until they're forced to, usually in their 30s when buying a house. But you should be working on this in your 20s. Having different types of credit shows lenders you can handle various financial responsibilities. This means having a mix of revolving credit like credit cards and installment loans like a car payment or student loans. You don't need to go into debt just to diversify your credit, but if you're already planning to finance a car, doing it in your mid-20s instead of paying cash can actually help your credit profile. The key is only taking on debt you can afford, and that serves a purpose. A small personal loan that you pay off responsibly can boost your score more than you'd think. Just never take on debt solely for credit building if it puts you in a bad financial position. Number 4. Getting approved for a premium credit card. Premium credit cards with great rewards and perks usually require a credit score above 740. Most Americans don't qualify for these until their mid to late 30s. But you should be targeting this milestone by 30 at the latest. Why rush to get a fancy credit card? Because these cards offer cash back rates, travel rewards, and benefits that can save you hundreds or even thousands of dollars every year. We're talking about 2 to 5% cash back on purchases you're already making, travel insurance, airport lounge access, and purchase protection. Over a decade, the difference between using a basic card and a premium rewards card can be tens of thousands of dollars in lost value. The path to getting approved is straightforward. Build your credit early, maintain a score above 740, and show a solid income. If you've been following the earlier milestones, you should be in great shape to apply for premium cards by your late 20s. Number 3. Paying off all high-interest debt. This milestone isn't about your credit score directly, but it's crucial for your financial health and future creditworthiness. Most Americans carry high-interest credit card debt well into their 40s, but you should aim to be completely free of any debt over 7% interest by your early 30s. High-interest debt is a wealth killer. If you're paying 18% interest on a credit card balance, you're basically working for the credit card company. Every dollar you pay in interest is a dollar that could have been invested, saved, or used to build wealth. Getting rid of high-interest debt also improves your credit utilization ratio, which is 30% of your credit score. Once you're debt-free, your score will jump, and you'll have more borrowing power for things that actually matter, like a mortgage. Create a debt payoff plan using either the avalanche method, where you tackle the highest interest rate first, or the snowball method, where you pay off the smallest balance first. Just pick one and stick with it until every high-interest debt is gone. Number 2. Qualifying for the best mortgage rates. Most Americans buy their first home in their mid to late 30s, but many don't qualify for the best mortgage rates until their 40s. You should be mortgage ready with a 760-plus credit score by your early 30s. Why does this matter so much? Because mortgage rates are determined by your credit score, and even a 0.5% difference in your rate can cost you tens of thousands of dollars over the life of a loan. On a $300,000 mortgage, the difference between a 6% rate and a 6.5% rate is over $30,000 in extra interest over 30 years. That's a new car you're basically giving away to the bank. To qualify for the best rates, you need a credit score above 760, a solid payment history with no recent late payments, low credit utilization, and a debt-to-income ratio below 43%. If you've been building credit since 18, paying everything on time, and keeping your debts manageable, you should be able to hit this milestone by 32 at the latest. Number 1. Achieving an 800-plus credit score. An 800-plus credit score is like having a financial superpower, but most Americans never reach it, and those who don't get there until their 50s or 60s. You should be aiming for 800 by your early 40s. At this level, you qualify for the absolute best rates on everything. You get approved for any credit product you want, and you have maximum negotiating power with lenders. The benefits are real. Insurance companies give you better rates, landlords trust you more, and some employers even check credit for certain positions. Getting you 800 requires patience because you need a long credit history, but you also need perfection. That means no late payments ever, credit utilization under 10%, a diverse mix of credit types, and minimal hard inquiries. You can't rush this milestone, but if you start building credit early and maintain excellent habits, reaching 800 by 40 instead of 60 saves you decades of paying higher rates on everything. Credit rewards timing, not effort. The earlier you understand the rules, the less you pay to learn them the hard way. Which milestone surprised you the most? Drop it in the comments. And if this video helped, like, subscribe, and share it with someone who's still learning the game.